Go ahead.
Good morning, and welcome to the Bober Markey Fedorovich webinar on business and individual tax planning moves to consider before year end, presented live on Wednesday, December 7th, 2022. Thank you for joining us this morning. The uncertainty and challenges from 2020 have continued to spread well into 2022 and will most likely join us as we bring in 2023. During today's discussion, we're going to review what's changed in the tax landscape, what's coming, and what planning steps you should take before year end. We'll also discuss the recent tax law changes that may still be impacting you or your business. If you're listening to us live, please use the Q&A box to submit your questions and we'll address them as we go or at the end of our discussion. If there are any questions that require an in-depth response, we may follow up with you offline so that we can dedicate the appropriate time and attention to your inquiry. This live presentation qualifies for up to 1 credit hour of CPE. To qualify for CPE, we'll be doing polling questions throughout the presentation, which need to be answered during the webinar. This presentation is also being recorded, so if you're able to review the presentation later, if you're watching the recorded version and have questions, you can email your questions to info@bmf.cpa. I'm Tyler Chaplin, a senior manager in our tax department, and joining us today is Melissa Dunham, also a senior manager in our tax department, who will be kicking things off now.
Thank you, Tyler. I wanted to start the business section with a polling question to see where everyone thinks we are legislatively for 2022. Do you think we have more certainty with the 2022 tax year than in the past few years? So, as you know, we have a split Congress. The Republicans have control of the House and the Democrats have control of the Senate. So we're not really expecting any major tax packages to flow through before the end of the year or thereafter. With that, we do expect them to focus on this December 16th deadline for the government funding, and hopefully it won't be shut down. It may result in a continuing resolution that will extend until December 23rd or later before they pass anything. We are hearing many discussions still coming around about the tax extenders, the defense funding, and other items. So something may get pushed through and we don't know what it will include. So we need to be aware of what could potentially happen, but focus on the items that we know now and the current law. So items that are new in 2022 based on the current law that's already out there. The first item I want to talk to is the change in the research and development expenses. This one has been talked about for a few years. We knew it was coming down the pipe. If you don't know what research and development expenses are, in general, these are typically costs that are related to the development or the improvement of a product. In the past, 2021 and previously, the expenses for this research and development were able to be expensed immediately. This was a great incentive to businesses who were putting a lot of money into R&D because they could see the immediate benefit, in addition to possibly qualifying for a research and development credit. But in 2022, these expenses that are incurred domestically for domestic R&D will need to be capitalized and amortized over 5 years. If you have a team out of the country doing this, that will then be capitalized for 15 years, capitalized and amortized for 15 years. So if you have a significant amount of R&D, this could definitely change your tax picture for 2022 going forward. Another item to mention is the interest expense limitation. This is primarily aimed at larger companies or groups of companies. This is based on the previous 3 years' receipts to qualify or be pulled into this limitation. So this in 2022 is $27 million of gross receipts for the previous 3 years, and it's been indexed for inflation. It'll be $29 million in 2023. In general, what this is a taxpayer is limited to 30% of their adjusted taxable income as a deduction. So in 2021 and previously, this included an adjustment for amortization and depreciation, which definitely helped our manufacturing companies take advantage of their deductions. This is no longer available, and they'll have a larger hurdle in order to deduct this interest expense. Again, this is only for the larger companies that fall into those buckets. And as we know, interest rates are increasing. So you may have a larger interest expense in the future that may be limited. The Inflation Reduction Act was a package that included tax items that was passed earlier this year. The focus of it was on clean energy and sustainability through incentives and tax credits. The tax credits are focused for the green manufacturing and technology sectors. It was focused to build out the renewable energy and improve energy efficient buildings and similar items. There was a large section in that too about the funding of the IRS. So they've been at an all-time low, as we keep seeing in the news, for their funding. This will then give them $80 billion over the next 10 years. And it'll go into different buckets such as enforcement, technology, advancements, and modernization. And I was looking forward to the taxpayer services being improved and putting money there. Unfortunately, it is the lowest percentage of the money is going to that area. So as you've probably read, over 50% of this funding is going to enforcement. Therefore, we are expecting more audits of high wealth and income individuals, complex partnerships, large corporations, and tax credits. Looking forward to 2023, items that are on the horizon that we're aware of, the restaurant meals deductions, those are going back to 50%. So the last 2 years, 2022 and 2021, these restaurant meals were able to be expensed at 100%. That was focused on stimulating the restaurant industry after their decline during COVID. Bonus depreciation, the 100% expensing immediately of capital improvements or purchases of fixed assets and those pieces, that is also going to be reduced in 2023 to 80%. That is part of the Tax Cuts and Jobs Act, items that are sunsetting at the end of 2025. The business depreciation for the bonus piece, that will then be phased out 20% each year and end up being 0 in 2026 under the current law. So most of these Tax Cuts and Jobs Acts items that are being sunsetted are going to impact the individual level. So Tyler will be discussing these more during his section. So we're coming to the end of 2022, and you can still take action to change your tax situation within these last couple weeks and set yourself up for 2023. So these are items that I want to talk about that you may have considered last year, but with the uncertainty of the BBA and whether it was going to get passed or not late in the year, you may not have executed on any of these items. So it's really good to revisit them this year and every year with the new items that are changing within your business. So depending on your tax situation, you may want to accelerate or delay income recognition, or accelerate or delay expenses. The timing is important with these items, especially at year end. So reasons you may want to accelerate or delay one of these items is when you look at your company's performance. You may be in a position where you are expecting a net operating loss this year. So this deductibility may be limited as it flows through to an individual tax return. There are limits for deducting net operating losses of $270,000 for single or $540,000 for married filing jointly. And corporations, they are not able to take any losses in the future if they are over 80% of the taxable income. They're limited to 80% of taxable income in the future, along with at the individual level as well. So it's not worth increasing an NOL if you are expecting income in 2023, because you may not be able to offset that whole amount of income with your NOL. So you can look at accelerating income into the current period or delaying deductions and pushing it into the next period. Interest expense limitation. I just noted above, it could be limited, and that is based on your prior 3 years of gross receipts for your company or the group that it's in. So if you're close to that 27 million average gross receipts for the previous 3 years, if you're able to delay some of those gross receipts and get under that hurdle, it could help your business with that interest expense deductibility. Other items to consider when you're looking at accelerating or delaying income or deductions are if you have basis limitations. Are you in a service business and qualified business income may be limited for the qualified business income deduction on your personal return, or other items on your personal return may be limited depending on your adjusted gross income. So you may be asking, well, how can I do that? How can I delay income? How can I accelerate income? Well, let's talk about reviewing your accounting methods. So are you on cash basis or accrual basis? Those same 3 prior year gross receipts, that level is in play for changing a cash basis. If you're under that 27 million gross receipts for the previous 3 years, you could possibly change to cash basis. And when you're on cash basis, you report the income when actually or constructively received, and your deductions when they're actually paid. So you could defer income by billing something later, so it can't be paid if it wasn't billed, or you can accelerate or delay payments that could shift your position. On the accrual method, you're recognizing income when the right to receive that income is fixed, and you're recognizing deductions when all events have occurred creating that liability, and it can be determined with reasonable accuracy. So you can delay shipping of products or potentially start services in January rather than before year end. You can review your accounts receivable. Are there bad debts? And maybe some companies on there that have declared bankruptcy in the last 2 years that should be written off completely. You're not going to be able to follow up with them. If they're sitting in an allowance account, it's off your balance sheet for GAAP. It's not included in your AR. But for tax, we can't take that deduction on your return until it's actually written off. Inventory policies, review those. Do you have slow moving inventory that you don't expect to be selling? Look at scrapping it before the end of the year, and then you can take it as a write-off against that and remove the asset from your balance sheet for tax. Look at the bonuses that you're expecting to pay. So do you want to increase your income before year end to take advantage of possibly some incentives you could take, or do you want to make sure you get that deduction? Well, you need to make sure that your bonuses are fixed and determinable by year end, and that you pay them within 2.5 months after the year end or before the close of the year. So with that, you can change the timing of your payment for those bonuses and then shift your deduction into each period. You can look at your revenue recognition policies, see if something should be changed, and consider your retirement plan contributions. Have you maximized the contributions? Or look at profit sharing, and the timing of that payment as well can be shifted based on when you want to take that deduction. So there may be some other items that you can talk to your tax advisor that are specific to your business that you may be able to move back and forth based on your accounting policies or what's happening in your business. Fixed assets. Those are the fun ones that we always talk about at year end. So are there items that you're planning to purchase that you need in January? You can look at making that purchase, and hopefully it can be delivered and placed in service before year end, and you can get that expense. In the current year, we have 2 different ways to expense a whole purchase of maybe a piece of furniture, a desk, or a machine. For the smaller businesses, you can take advantage of Section 179. This is a way to take 100% of depreciation up to $1,080,000 in 2022, but you cannot put in over 2.7 million of capital improvements. This cannot create a loss under Section 179. So you'd be limited to zero going through. But the piece of this as well is it's more advantageous in some states, because some states will not allow you to do bonus depreciation or Section 179, but there's quite a few that will follow the Section 179 expensing of fixed assets. Bonus depreciation, like we talked about earlier, it's going to be phased out, but this year you can still have 100% depreciation. If you want to shift that purchase into next year, you could still take 80% in 2023 and then depreciate the remaining 20% over the future life of the asset. You can look at your de minimis policy. So this is when you purchase an asset. If it's under a certain threshold, it can be expensed. If you have audited financial statements, that limit is $5,000 per item that's on a receipt. And if you do not have an audit, it'll be $2,500, which is the set amount. The key with this item is there's a policy that has to be in place at the beginning of the year, and then it needs to be followed for books as well as for tax. So this is something that you can think about, either delaying this deduction or accelerating it into this current period for those pieces. You should also be looking at potential tax credits that you could take. The list I'm going to give is not all inclusive, but they're items to consider. The employee retention credit, that is the big one. I'm sure many of you are getting phone calls from some companies, seeing if you've checked on this credit yet. If you haven't, you definitely should check in and see if you qualify for it. So you need to be aware of these companies that are saying that every company should qualify. This isn't for everybody. It came about during the COVID times, as you probably know. And the focus was to keep employees employed in your business and to help offset their wages that you're paying with this credit. There are thresholds, so you need to be able to qualify to take this credit in 2020 and 2021. You have to have a decline of gross receipts, and you can, if you do not have that decline in gross receipts, you can look and see if you were partially or fully had your business suspended. So are you in a restaurant industry and you had to close your dining room, or did you have to close down completely? So if you meet these requirements, it can be a very lucrative credit that you are entitled to if you meet these qualifications. There's employer provided childcare, R&D credit, the small employer health insurance credit, the work opportunity tax credit still around if you hire targeted groups. As I mentioned earlier, there's quite a few green credits. And then there's other industry specific credits that are out there that you may qualify for if you look into them. So next, we're going to move to the state and local section. And I will have another polling question. Out of curiosity, where are you attending this from? Are you doing it while you're at work? Are you working from home? Are you on vacation on the beach somewhere? So this question leads right into my topic of Nexus considerations for your business. You're probably wondering, what in the world is Nexus? I hear you guys talk about this all the time, this word, but I don't fully understand it. Nexus is the amount of business activity that must be present in a state or city for taxpayers to become subject to taxing in that jurisdiction. This is typically done with having employees working in this state or city, or having inventory or property in it. Some other items can qualify too, but these are the big ones. So I see most of you guys are doing this from your office. I'm disappointed no one wanted to log in while they were at the beach though. So I know it's an exciting time to talk about year-end taxes. So I know as I mentioned, that you could have the employees working anywhere, and your footprint and your business operations may have changed the last couple of years. So as your employees are working from home, or you're hiring people out of state because of the workforce shortages in this area or in your area, this is something to consider. Did you hire somebody in another state? Or did you start letting your employees work from home? Are you permanently working from home? This could create more filing obligations, and it's a good idea to look at those and be aware of them before year end. So, as I mentioned, you may have more states that you should be filing in, and other states have put in pass-through entity taxes over the last couple of years that were for the purpose of avoiding the Tax Cuts and Jobs Act ceiling on the itemized deductions for state taxes. So every state has different rules, and you really need to look at your level of activity, your shareholders, and see if it's a benefit to file and have the taxes paid by the entity rather than flowing through to the individual. Ohio has created a new pass-through entity tax for 2022. So we've looked at this, and it's not going to make sense for all of the businesses in all cases. You really need to look through to the owners and the particular tax situations and where they are. This is something that you can elect into every year. So if you don't do it this year, you could do it next year, or vice versa. Here, the entity will pay the tax and receive a full deduction. The individual will then be able to take the credit on their return. Estimated taxes are due for this tax, so you may want to consider making a payment before year end. And the tax rate is 5% for 2022, and then it falls to 3% next year to be in alignment with the individual rates. So at a high level, it's looking like this will be a benefit for Ohio residents that have Ohio businesses, or if the business has an owner that's in a non-taxing state. Not all states are going to be giving credit for this tax. So if you have a shareholder or a partner in Pennsylvania, it may not be beneficial because they're not going to be getting credit for this tax, and you may end up paying more tax in the end. Tyler is going to be discussing this Ohio pass-through entity tax further in his individual section. And I wanted to end out the business section of the presentation with a reminder that Ohio has an Ohio centralized filing election that you can elect into to file the municipal taxes with one return for income taxes through Ohio. This is a great opportunity for you if you have employees working in many different cities now, since you may have a work from home policy. This allows you to then have one set of estimates you pay and filing one return to report it to all those cities for income taxes. If you haven't already elected into this, or you have any questions on this, you should reach out to your tax advisor as well. So I'm going to pause here and see if anybody has any questions at this time before we move on to Tyler. All right, it doesn't look like we have any. So Tyler, you can proceed with the individual section.
Okay. Hey, thanks, Melissa. That was very informal, very informational. We appreciate that. So I get questions constantly, especially this time of year, of Tyler, what can I do for individual tax planning before year end? Got to be honest, individual tax planning is not a one size fits all. Each tax situation is unique, and what might make sense for one taxpayer doesn't always make sense for another taxpayer. So today I'm going to be reviewing some year-end tax strategies, but please reach out to your CPA or trusted advisor to see what makes sense in your situation. Before I discuss these, I also want to first showcase some items that that had changed from 2021 tax year. The first thing is the child tax credit. In 2021, that child tax credit was $3,000 for children the ages of 6 through 17 and $3,600 for children 5 and under. This year in 2022, it's only $2,000 per qualifying child. And one other note to make about that, The children who are 17 qualified in 2021, they do not qualify in 2022. So if you have a 17-year-old at home, unfortunately, as of right now, unless Congress changes something, you will not be getting a child tax credit for that child in 2022. In 2021, that child tax credit was fully refundable. Now it's back to a non-refundable credit. It goes back to the 2020 tax year where it was non-refundable. And then finally, the last thing I want to say about this child tax credit, in 2021, for those that did receive, you may have received some advanced child tax payments throughout the year that could have either been direct deposited or the IRS sent you a check. That didn't happen in 2022. It did create a lot of issues at tax filing time. So there was no advanced child tax payments throughout 2022. In 2021, the child independent tax credit was worth up to 50% of $8,000 in eligible expenses. This is preschool, daycare, any child or dependent tax credit or expenses. Those were eligible for this credit. So it was eligible for up to $8,000 in eligible expenses for one child or $16,000 for two or more children in 2021. This credit was phased out as income exceeded about $125,000. That credit was fully refundable in 2021. However, in 2022, this credit is no longer refundable. And the maximum credit percentage drops from 50% to 35% of expenses for one child and $6,000 for more than one child. That means the maximum credit is $1,050 for one child or $2,100 for two or more children. However, bad news, that credit begins phasing out of income after only $15,000 of AGI. So if you're making a lot more than that, unfortunately, that child and dependent tax care credit is probably not an option. In 2020 and 2021, the IRS allowed an above-the-line deduction for charitable contributions. Then that's for taxpayers who claim the standard deduction. The IRS also said, hey, if you contribute to a charitable organization, even though you take the standard deduction, we'll give you a deduction of either $300 for individual taxpayers or $600 for married filing joint taxpayers. However, in 2022, that deduction went away. So if you want to claim charitable contributions, unfortunately, you'll have to itemize your deductions. We'll talk more about itemized deductions later. Also, regarding charitable contributions, in 2020 and 2021, there was a suspension of the 60% of adjusted gross income limit on deductions for cash donations by people who itemized. That's now expired. So that limit of 60% is now back to 2022. So if you have high charitable contributions in 2022, make sure you might have some limitations on your AGI. Speak with your tax advisor on that one. You can still deduct the value of appreciated long-term property held for more than a year for up to 30% of AGI. And then for private foundations, cash gifts are limited to 30% of adjusted gross income, and gifts of appreciated property are limited to 20%. We're going to discuss more about charitable contributions here later in this presentation. We may have a question here. The question is, does the child tax credit cut off the year a dependent turns 17 or begin the year at 17? For that question, it's 17 by year end. So the cutoff, as long as the student is 17 by year end, they do not take there's no child tax credit there. Good question though. Thank you. All right. Next slide. All right, for 2022, the tax year 2022, third-party payment companies, this is Venmo, this is PayPal, they're gonna start sending 1099-K forms for taxpayers who are paid over $600 for goods and services. In previous years, these companies didn't send 1099-K forms until you were paid $20,000 for goods and services. So taxpayers are expected to report income on their tax return if he or she receives a 1099-K. Remember though, this is for goods and services only. So if you're reimbursing your friend who paid for your Taylor Swift concert tickets, it's not going to apply. Those are reimbursable expenses. This is for goods and services only. All right, as Melissa had mentioned, the Inflation Reduction Act was passed in August 2022. This is mostly a lot about clean energy, surrounded by clean energy. The residential clean energy credit replaces the residential energy efficient property credit. There is now a 30% tax credit on all qualifying investments placed in service in 2022. This is solar electric property, solar water heaters, geothermal heat pumps, small wind energy property, biomass stoves, and fuel cell power plants. I got to be honest, some of those, the biomass stoves and fuel cell power plants, I don't see those a whole lot. So that's a 30% tax credit if you place those in service. Included in the Inflation Reduction Act was this clean vehicle credit. Most of these provisions for the clean vehicle credit don't apply until 2023. The biggest takeaway for this clean vehicle credit is the final assembly of qualifying clean vehicles must occur in North America and is effective for vehicles sold after August 16, 2022. So the IRS has released a long list of what vehicles qualify. Check with your CPA to determine if your new vehicle satisfies this requirement. All right, another item. Due to inflation, the IRS adjusted the standard mileage rates mid-year. This is kind of unheard of. IRS doesn't usually do this. From January 1st through June 30th, the 2022 standard mileage rate is 58.5 cents per mile. That's up from 56 miles in 2021. So if you're a business owner, you can deduct 58.5 cents per mile from January 1st through June 30th. As I said, they changed it halfway through the year. From July 1st through December 31st, the 2022 mileage rate is 62.5 cents per mile. Medical miles are 18 cents for the first half of the year and 22 cents for the second half. That's if you take the itemized deduction and you're eligible for the qualified medical expenses. All right, cryptocurrency reporting. This is big over the last couple of years. For those involved in virtual currency trading, note that the IRS is requiring more and more platforms that buy and hold cryptocurrency to start producing Form 1099s. These go directly to the IRS, so be sure to provide your tax preparer with all the necessary information to properly report all gains and losses from virtual currency transactions. I think there's going to be a lot of losses there as of right now. The tax force was created by the IRS to monitor taxpayers that trade in cryptocurrency. So, of course, the IRS wants their share of all this. IRS is considering adding a question to business tax returns for taxpayers that trade in crypto. There is a question on the individual Form 1040, but they're considering adding that to business tax returns as well. All right, let's do a polling question. Are you planning on using the standard deduction for your 2022 taxes? Yes, no, or unsure? Okay. Give it a couple more seconds to leave that polling open. All right. Let's move to the next slide. Right now, we're going to talk a little bit about retirement planning, and then we'll jump back to those the standard deduction and itemized deduction here. All right, retirement planning, it's a big thing for year end. Under the age of 50, taxpayers can contribute up to $20,500 in their 401k. There is a catch-up contribution for those older than 50 of $6,500. There's also the IRA contribution up to $6,000 for taxpayers under the age of 50. And then there's an additional $1,000 catch-up contribution for those older than 50. Now, with the IRA contribution, that can be done right before you file the tax return. So if you're not filing until April 14th, no reason to make an IRA contribution if you haven't already done that until we file that tax return. For 401k contributions, though, however, that has to be done by year end. So if you're planning on making a large 401k contribution, make sure that's done before 12/31. There's then for self-employed individuals, the maximum SEP contribution is $61,000 in 2022. That's up from $58,000 from 2021. And once again, that SEP contribution can also be made before filing the tax return. Some more retirement planning. Be sure to take your required minimum distribution before December 31st. If you are at least 72, but before the end of the tax year. There's penalties if you don't take those RMDs by the end of the year. And then there is a 10-year period for inherited IRAs under the Secure Act. So make sure if you're receiving an inherited IRA, there may be some new rules on that. Check with your tax advisor, as there's a 10-year time limit for distributions out of an inherited IRA. Looks like we have another question. All right, the question is, millions of taxpayers will be receiving a 1099-K in 2023 for tax year 2022. Will the IRS be requiring the 1099-K info be entered on the 1040? How is the IRS going to use the 1099-K info? How does the 1099-K info differ from, say, a 1099 dividend? That's a great question. The main thing is, again, for goods and services, that 1099-K is going to be required. If you're paying somebody for or if you're receiving money for a product you're selling, through Venmo, through PayPal, you're going to be receiving a 1099-K if those goods and services or if you're being paid for goods and services over $600. So it's kind of like a 1099 NEC form, 1099 NEC or 1099 miscellaneous form that may be received in the past if you're selling those, if you're a self-employed individual. So yeah, the IRS is expecting to report that income if you receive it. That's a great question. I'd be happy to follow up offline if we need further guidance. All right, and one other question about those 1099-K forms. How do they know if they're goods and services and not just personal transactions? Personally, I use Venmo a lot. Whenever I'm about to pay somebody for Venmo, there is a checkbox right before the pay button that says this is for goods and services. I'm not exactly sure how it comes up on PayPal, but there is a box before I pay somebody that asks, is this service for goods and services? Great questions. All right. Continue here. We talked about retirement planning. Let's move into pulling income and deferring deductions. So as I said in the beginning of the presentation, every tax situation is different. It may make sense for some individuals to accelerate income into 2022, such as if you're expecting to be in a higher tax bracket in 2023. If that's the case, it may make sense to push income into this year and defer any deductions into next year. So what are some strategies we can bring income into for this year? The first is accelerating installment sale gain. If you're eligible for an installment sale, by electing out of the installment sale method, a taxpayer may recognize the entire gain this year in this year of sale. This election must be made on a timely filed tax return that's including extensions and is irrevocable once made. There's also recognizing capital gains. Harvesting capital gains is an ideal strategy to hedge against future potential increase in capital gains tax rates. A taxpayer can increase their cost basis by selling an appreciating investment and then use those sales proceeds to repurchase the same or similar investment. While the sale will realize a taxable gain, the repurchase of the investment will provide a stepped up cost basis and later yield a gain when the investment is sold in the future, maybe when the capital gains rate is higher. Also, to recognize income this year, there's always the option of converting a traditional IRA to a Roth IRA. If you recognize ordinary income now, future growth and tax and distributions are completely tax-free. There are also no RMDs to worry about once the taxpayer turns 72. Now, converting traditional IRAs to a Roth IRA, sometimes it's a great idea. Sometimes to be honest, it's an awful idea. Please check with your tax advisor to see if that makes sense in your situation. All right. There's also decreasing adjusted gross income before year end. Maybe next year is going to be, a different type of year. So, hey, maybe we want to decrease AGI this year, and so we can recognize income a little bit more next year. First is recognizing capital losses this year. Offset any capital gains by recognizing capital losses in your portfolio. Remember to note, though, for taxpayers, that you may only utilize $3,000 of capital losses each year. Also, be wary of wash sales. A wash sale is when an individual sells or trades at a loss, and then within 30 days before or after the sale, they buy the same or substantially the same investment. So be wary of that. I know I had a few taxpayers that got caught up in wash sales last year. They weren't able to take that deduction. As we spent some time before, contributions to retirement plans, they're a great way to offset taxable income. And then contributions to an HSA or FSA. Right now, the HSA max contribution is $3,650 for individuals and $7,300 for families, with an additional catch-up contribution of $1,000 for individuals age 55 or older. Okay, and then there's always the deferring debt cancellation events. If you're going to do a cancellation of debt, maybe you can just defer that to next year. And then one other item is qualified charitable distributions from a RMD or required minimum distribution. In addition to making cash or non-cash contributions all year, you can also realize tax benefits by making charitable contributions from your retirement accounts. This is for individuals older than 70 and a half years old, and they can make what's called a QCD or qualified charitable distribution from a traditional IRA account. Eligible individuals can donate a total of up to $100,000 to one or multiple charities by transferring the amounts directly from their IRA to this charitable organization. These contributions are made in lieu of taking an RMD for the year, and the Secure Act increased the age at which RMDs must be taken from 70 and a half to 72. However, QCDs can still be done at 70 and a half. That hasn't impacted that. We mentioned a little bit, ordinary and capital tax gain rates could increase in the futures. As of right now, we expect to stay the same. Who knows what could happen with Congress? So you may, as I said earlier, you may want to recognize long-term capital gains now. And if you want to buy back, you can expect capital gains if you expect capital gains rates to increase in the future. All right, next slide. Okay, wanted to talk a little bit about passive activities. Passive activities, so the IRS usually defines two types of investments. Either you're active in the business, you're managing the business, you spend a lot of time, most of your time in the business, or maybe you're more of a passive, it's considered a passive activity. You're more of just an outside investor, you don't operate in the day-to-day. IRS has a long list of it's 7 different criteria and qualifications that define if a participant is passive or active. Right now, so passive, if you have a passive loss, that can only be offset against passive income or in the year you sell the passive activity. So maybe to free up some of those passive losses, if you do have passive losses, you can increase your participation in passive activity. Usually it means working at least 500 hours in the activity. Again, there's a long list of requirements for the IRS, but if you increase your participation in that passive activity, you can start taking some of those losses. Also consider sale of a passive activity to free up some of those losses. As I said, you may be eligible to take those losses in the year of a sale. So meet with a tax advisor to discuss that. Itemized deductions. Right now, the standard deduction for married filing joint filers is $25,900 and $12,950 for individuals. That's an increase of $800 for married filing joint and $400 for individuals from 2021. Some other itemized deductions, medical expense floor, that's 7.5% of AGI. So if you have a lot of medical expenses, you may be able to take some of those expenses against your tax return. That SALT cap, Melissa mentioned that a little bit. That SALT cap right now is $10,000. Some states, though, are providing a workaround through that passive entity tax. As Melissa said in her presentation, if a taxpayer is in a partnership or an S Corp and has significant state income, it may make sense for the entity to elect pass-through entity taxation. If you're a partner in a partnership or a shareholder in S Corp, please reach out to your tax advisor and contact the person at the entity to determine if an entity should elect pass-through entity taxation. We talked a little bit about charitable contributions earlier. Consider donating long-term stock with high fair market value and low basis. Consider bunching your strategy. Consider a bunching strategy on medical expenses and charitable contributions. Maybe you have a big surgery planned. Maybe you can push that off this year, take the standard deduction next year and then bunch that all to next year where you take medical expenses, you take charitable contributions, and that way you can itemize next year. That's a popular strategy I like to use. And then another thing for itemized deductions, casualty losses for Hurricane Ian this past fall. The IRS is allowing casualty losses for Hurricane Ian. So anybody that has a property that was affected by Hurricane Ian, you may be able to claim some deductions against that on that property. Be wary of the net investment income tax. That's 3.8% on net investment income. That's your dividends, your interest, your capital gains, your passive activity income. So be wary of that. You're going to be hit with another 3.8% tax on those if your modified adjusted gross income is over $250,000 for married filing joint, or $125,000 for separate, or $200,000 for individuals for all others. All right. Unless Congress votes to extend the Tax Cuts and Jobs Act that was passed in 2017, the following changes are going to occur. Tax rates will go back to 2017 levels. The highest tax rate in 2017 was 39.6% for individuals. Right now, the highest rate is 37%. They'll also go back to a lower standard deduction. 2018 saw the standard deduction nearly double. And so that's a possibility that 2017 standard deduction is going to go back to those types of levels. Removal of the SALT cap. That's that $10,000 for real estate taxes and state and local income taxes. That may make that pass-through entity taxation go away. We'll have to see if that's extended. The AMT threshold, the alternative minimum tax threshold, is going to increase back to 2017 levels. Right now, there's a big deduction in those AMT thresholds. So that could potentially go back up if Congress doesn't vote to extend the TCJA. The QBI, or qualified business income deduction, that's a 20% deduction on pass-through entity income. That is set to expire at the end of 2025 as well. So be wary of that. And then finally, the estate tax exemption is expected to go back down to roughly about $6.8 million if these aren't extended. Let's talk a little bit more about estate tax exemptions right now. Next slide, please.
Tyler, before you move on, we do have a couple questions from the last slide.
Great. All right. Have there been any changes to 529 plan deductions or contribution restrictions? Great question. No, there's still a $4,000 deduction at the Ohio level for each qualifying dependent. And then, is rental business, is that considered passive income? That's $1 million question for the most part. Generally, it is. There are specific rules the IRS has if you're a real estate investor, or if there's self-rental, if you're a business owner and you have a property that you're renting through the company. There is a huge code section on all this. I'd be happy to talk offline, but right now I'm going to say most of the time real estate income is considered passive income. Thanks, Melissa. All right, and then this slide, talk a little bit about gift tax. Right now, the annual gift tax exclusion for 2022 is $16,000. That's scheduled for $17,000 for 2023, an increase of $1,000. So be sure to make exclusion eligible gifts by year end if you're planning on gifting to a child or grandchildren or just any family or friend. Be sure to do that before year end. Gift and estate tax exclusion amount is currently at about 12.06 million. That's expected to increase to 12.92 million in 2023. Again, I mentioned earlier, in 2026, the threshold will drop to $6.8 million. In 2026, your estate threshold is going to be the greater of the estate tax threshold then, which is 6.8 million, or the total taxable gifts you have made during your lifetime. I'm going to pop up our last polling question. Have you or are you planning to make a gift in 2022? Yes, under 16,000, yes, over 16,000, or no, I am not planning on making any gifts before year end. Leave that open for a couple more seconds. In the meantime, we have another question. Thoughts on the Ohio Scholarship Tax Credit? This looks like to be a no-brainer. Yes, that Ohio Scholarship Tax Credit is available. What it is Ohio has released a list of eligible organizations that you can contribute to a scholarship. This is both a qualified deduction at the federal level for charitable contributions, and then you're eligible for up to taxpayers are eligible up to $1,500 of the Ohio Scholarship Tax question or tax contribution. So that's a great question. Thanks for that. All right, there's the polling. 23% said yes, and then 73% said no, I'm not planning on making a gift. So thanks for those responses. I'm gonna leave up for any questions then on the individual side or on the business side. If you weren't able to ask Melissa a question, she'd still be able to answer that for you. I like the questions. Keep bringing them in. This is great. Are there any credits deductions for first-time home buyers in 2022? I'll be honest, off the top of my head, I don't believe anything, but I can get back to you if Melissa, I know you're on mute. Are you aware of any?
So I am not aware of any at this time. I'm with you, Tyler. Don't know of any.
Okay, some other questions. Repeat gift limits, and can you gift to multiple relatives? So gift limits in 2022 are $16,000. And that's, yes, you know, anything over $16,000 is fine too. We do have to file a gift tax return. Again, that threshold for gift tax is currently 12.06 million. So unless you've gifted over 12.06 million in 2022, you're not going to be hit with any gift tax, but we will have to file a gift tax return if you contribute over $16,000 per individual. Hopefully that answers that question. With the reductions in 2022 market values, should I consider converting my IRA to a Roth? That's a great question. And as I mentioned earlier, it's not always a one size fits all. You know, it all depends on different factors, different tax brackets. I'd be happy to answer that question offline and maybe do some tax planning.
Thank you for all of your insight, Tyler, and answering all the questions that people had. So we want to thank everyone for joining us today. If you have any additional questions afterwards, you can send your questions to info@bmf.cpa. So thank you.